Okay, let's get into this. It's a crucial and I think often overlooked area of business planning.
It really is.
If you're an entrepreneur, a sole proprietor, or a partner in a small business, you already know this. Your health, your ability to work, that's
Yeah,
your number one asset.
absolutely.
But we have to ask the uncomfortable question. What happens when the unexpected strikes and you just can't work for months or even, years?
And that event, a long-term disability, it isn't just a loss of your personal income. For so many businesses, it really threatens the whole thing, the viability of the entire structure.
It cripples your ability to pay your debts.
It does, and it completely stalls any kind of succession plan. So our mission today is to really do a deep dive into the planning documents that can protect you. We're looking at two very specific strategies,
Oh,
things like BLPDI and buyout policies. Think of it like preventative financial care for the business itself.
I like that. So two distinct threats we need to deal with. First, the immediate one from creditors, and then the long-term one,
Yeah.
the business just dissolving.
Exactly.
So let's start with that immediate triage, protecting the debt. We're talking about something called Business Loan Protection Disability Insurance, or BLPDI.
Right. And this is a very, very focused kind of insurance. Its job, and really its only job, is to discharge payments on specific business loans while the owner is disabled.
Okay, just the loan.
Just the loans. It can cover the periodic payments, the month-to-month stuff, or in some cases, a big lump sum payment to clear the obligation.
Okay, wait a minute. If I'm a business owner, I might already have something called Business Overhead Expense Insurance, right?
Yeah.
BOE.
Yeah.
It covers my rent, my utilities.
Mm-hmm.
Why do I need BLPDI? Isn't that just paying twice for the same thing?
That's a great question, and it's where the real distinction is, BOE.
Yeah.
That generally covers your operating costs, which, yes, includes the interest part of a loan payment.
Okay, the interest.
But BLPDI is different. Its focus is on the principal repayment. So if you become disabled, you need something to cover that big capital obligation, and you can't double dip.
Ah, I see.
The business has to pick a lane when it files a claim. But because the policies meet different needs, one is for operating costs, the other for debt discharge, it's actually pretty common and necessary to have both.
Got it. So we're talking about the actual capital, not just the running costs. So who should be signing up for this?
Well, really, anyone whose business revenue is completely dependent on them actively working.
So sole proprietor.
Sole proprietors, partners, sole owners of incorporated companies. If you stop working, the revenue stops. But that debt clock, it just keeps ticking.
Can I insure any loan I have on the books? What if I, say, bought a new personal car through the company?
No, the sources are really clear on this. The loan has to meet three pretty rigorous criteria. First, it has to be essential for the business to operate successfully.
Okay, essential.
Second, and this is important for taxes, the interest you pay on it has to be tax deductible, which means the loan was taken out specifically to earn business income.
Right.
And third, it must be from a real financial institution, a bank, a credit union, a loan company.
So we're talking about things like the mortgage on your commercial building, the financing for your main equipment, lines of credit that fund your inventory, things like that.
Exactly. And when we look at the financials, most BLPDI benefits are paid out periodically, maybe up to $10,000 a month, usually for a maximum of, say, 24 months.
So it gives you some short-term breathing room.
It does.
But what if the debt is huge, like a big equipment loan that needs to be settled? Can you get a lump sum?
You can, but it is conditional. Lump sums are available up to maybe $250,000, but there's a big catch. They're capped at 75% of the loan balance, and you only get paid after a very long waiting period. We're talking a full year.
A whole year.
Yeah, it's designed for debt reduction, not for just instantly clearing it.
Okay, here's a really interesting part. The tax treatment. It seemed to confuse a lot of business owners. You're insuring a loan payment, which is a business expense.
Right.
But the premiums are not tax deductible. Why is that?
Well, the premiums aren't deductible because the loan itself is considered a capital asset. It's not a standard operating expense. But, and this is a huge but, that comes with a massive upside.
It's just...
The benefits you receive, so the money that pays off the loan principal and interest, that comes to you completely tax-free, and that tax-free cash is an absolute lifeline in a crisis.
Let's make this real with the example of Hideki, the independent contractor. He's a sole proprietor, does trench work, and he took out a 5-year bank loan for $200,000.
Right, for his main equipment, a front-end loader and a flatbed truck.
His entire business depends on him being in that loader.
Yeah.
If he gets disabled, the income just stops instantly.
And without BLPDI, the bank is going to seize that equipment. They'll just take it. And that wipes out his entire investment, his whole business future.
But a simple BLPDI policy, let's say with a 60-day wait and 60 months of benefits, that makes sure the debt is covered.
Exactly. The assets are safe from the bank while he recovers or, figures out what to do next.
So that puts out the immediate fire. It keeps the business out of bankruptcy court. But what if Hideki's injury means he's never coming back? The BLPDI saves the equipment, sure, but it doesn't solve who actually owns the business now.
And that leads us right into the second big problem: business continuity and the absolute necessity of having a buy-sell agreement.
Right.
For any business with more than one owner or even a sole proprietor whose business has real value, the moment the owner is permanently disabled is, well, it's the ultimate test. You have to plan for what happens to that asset, the business itself.
And if there's no plan, everyone suffers. I mean, the disabled owner and their family are stuck trying to sell their share of a business under just immense pressure.
Huge pressure. Meanwhile, the employees are panicking about their jobs, and the co-owners are stuck supporting a non-productive partner.
Or worse.
Or worse, they're suddenly dealing with the disabled partner's spouse or family member who now thinks they're a co-owner, making decisions, demanding cash.
Which takes us right to that cautionary tale of Darren's dental practice.
Yes. So you have Lawrence, Daryl, and Darren. They're cousins, partners. They own a booming dental practice together.
And they had the classic handshake agreement, right? We'll figure it out if something happens.
That's it. Then Darren has a bad car accident, faces a permanent disability.
And because they didn't have a binding funded buy-sell agreement, Lawrence and Daryl, they had no legal way and no cash to buy out Darren's third of the business.
None. They were forced into this grueling multi-year installment plan, which just tied up all the business's cash flow just to pay off the partner who was no longer there.
And here's the part of that story that's just infuriating. Darren's wife, Emily, was managing his assets. She wasn't part of any agreement.
Not legally bound at all.
So she just refused to give up ownership of Darren's specialized dental equipment. She was hoping their son might become a dentist someday.
Which meant Lawrence and Daryl couldn't even use Darren's old clinic space. They had to go out and buy brand new equipment at double the price they would have paid for Darren's share.
Just a brutal lesson.
A total mess. All because they failed to sign one piece of paper ahead of time.
So to prevent that Darren and Emily scenario, the agreement has to bind everybody. Who, specifically, needs to sign on the dotted line?
It's not just the owner. The owner's spouse or common law partner has to be a direct party to that agreement. That's critical.
Why is that so important?
Because in a lot of places, that spouse has an ownership or equalization claim against the business. If they aren't bound by the agreement, those legal tangles can just completely destroy the whole sale.
Okay, let's get into the mechanics of the agreement itself. The sources all point to one key principle: certainty. So instead of just listing the elements, let's talk about why they're so necessary. Like, why pre-decide the buyer and seller?
Well, because without that pre-commitment, the remaining partners might drag their feet, or the disabled owner's family might refuse to sell, trying to hold out for a higher price. The agreement has to legally require the owner to sell and the other partners to buy.
No wiggle room.
No wiggle room.
And the trigger is disability. The definition is usually regular occupation, so you can't do your main job. But this buyout isn't instant, is it?
No, and that's absolutely critical. The buyout is only mandated after a really long, predetermined waiting period, usually 12 months, sometimes longer.
And that's to allow for a potential recovery.
Exactly. But once that trigger period is met, the contract just takes over. The owner must sell, the buyer must die. It removes all the risk, all the negotiation, all the delay.
That dual protection.
Yeah.
Guaranteed sale for the seller. Guaranteed acquisition for the buyer. That's the security.
Okay, let's talk price. How do you set a fair price years before the sale might actually happen?
You definitely do not want a fixed price. That's the one thing to avoid. The risk of it being wildly outdated is just too high.
So what are the better options? The two reliable methods are, one, you agree on a price formula ahead of time, say 3 times the average earnings, or 2, you agree to use a specific binding third-party valuator when the time comes. The key is to take the pricing discussion out of the crisis moment.
Right. But a mandatory purchase is meaningless if the buyer has no money. This brings us back to funding. I mean, you could use personal assets or get a loan.
And those are all riddled with risk. Personal assets are rarely liquid enough. A loan requires debt service right when the business is already stressed, and you might not even get approved for one.
And installment payments.
Installment payments force the disabled owner's family to rely on the business's future profits. It just delays their financial freedom.
Which leads us to the best solution, a disability buyout policy. It's a specialized form of disability insurance, or DI.
Yes, it's the superior engine for this because it provides a guaranteed lump sum benefit right when that contractual obligation to buy is triggered. You can customize the whole policy, the benefit amount, the definition of disability, the waiting period, to perfectly match the legal agreement.
And speaking of waiting periods, that's the biggest difference with a buyout DI plan, isn't it? It's way longer than a standard disability policy.
It is. A regular DI policy might have a 30 or 60-day wait. These buyout plans are 12, 18, even 24 months long. And that's not negotiable. It's designed to match the contract, to ensure that by the time the money is paid out, the disability is considered permanent enough to justify selling the entire business interest.
And the benefit is usually a huge lump sum, up to $1 million, maybe $2 million. So what happens if the disabled owner recovers, say, 6 months after the payment has started? Do they get the business back?
No. Once that waiting period is met and the transaction is triggered, the deal is final. The payments continue, the transfer of ownership is complete, and it doesn't matter what happens to the seller's health after that.
That provides certainty.
It provides finality for everybody involved.
For growing businesses, though, you need the policy to keep up with the increasing value. What features handle that?
Well, you want a non-cancelable policy for sure. But the most important thing is the future purchase option, or FPO. This guarantees the buyer the right to increase the coverage amount at set dates without any new medical evidence.
Oh, that's huge.
It is. If your business doubles in value over 5 years, your coverage can double too, even if one of the owners has developed a serious health condition in the meantime.
Let's just quickly nail down the tax implications here. The money flows from the buyer to the seller using this DI policy.
It's pretty straightforward on the purchase side. The premiums the buyer pays are not tax deductible, but the benefits they receive, which they then use for the purchase, are completely tax-free.
Now, the structure of the legal agreement itself affects the seller's taxes when they sell their interest.
Yeah.
There are two main types, right? Cross-purchase and entity purchase.
Right. A cross-purchase is where the partners buy each other's shares directly. In that case, the seller just reports a simple capital gain or loss on the sale.
Pretty straightforward. What about the other one, the entity purchase, where the corporation itself buys back the shares? This gets a bit more complicated.
It does. When the corporation buys back the shares, the money paid out up to the value of the paid-up capital, or PUC, is considered tax-free capital.
Okay, hold on. For someone who isn't a tax lawyer, what's a simple way to think about paid-up capital?
Think of it as the original amount of money the owners invested to buy their shares, plus some other tax-free adjustments. It's basically the original capital base.
Got it.
So any amount the corporation pays the disabled owner above that PUC amount is considered a taxable dividend, not a capital gain. And that can have very different tax consequences for the seller.
That's a critical distinction.
Okay.
Let's finish with the dentists, Lawrence, Daryl, and Michael. They learned their lesson from Darren and decided to do it right. Their business was valued at $1.2 million.
And the ownership was split. Lawrence and Daryl each had 40%, and Michael had 20%.
They set up a mandatory cross-purchase agreement with a 12-month waiting period. So if Lawrence became disabled, Daryl and Michael were legally obligated to buy his $480,000 share.
Critically, their obligation was pro rata, based on their existing ownership.
And this is where the policy coordination is just so elegant. They set up 3 separate DI policies, one for each partner, focusing just on Lawrence's policy. He was insured for $480,000, but that policy was owned and paid for by Daryl and Michael.
Exactly. Daryl was responsible for 2/3 of the premium and Michael for 1/3, matching their obligation.
So when Lawrence gets disabled and that 12-month period ends,
Daryl receives $320,000 tax-free, and Michael gets $160,000 tax-free. They have instant guaranteed tax-free cash to meet their binding obligation to Lawrence's family.
that structure is the engine. It guarantees the sale works immediately, fairly, and without loading the business up with a ton of new debt.
That's right.
So what does this all mean for you? Well, effective business planning for disability, it really requires 2 separate synchronized strategies. You need that short-term debt protection, the BLPDI, to keep the lights on.
And you need the long-term succession plan, the buy-sell agreement funded by the disability buyout insurance, to make sure the ownership transfer is orderly and fair.
These plans don't just secure the owner, they secure the entire future of the business.
It's really the difference between a crisis that paralyzes your business and a crisis that just triggers a smooth, predetermined transfer of assets.
So if you are a business owner, how certain are you, really, that your co-owners or your family members are legally and financially prepared to buy your business interest at a fair price without leaving themselves or your family in years and years of debt? That's the question you need to be able to answer today.